On January 29, 2026, silver reached $118.87 per ounce, shattering its previous all-time high and entering uncharted territory. This isn't just another price spike, it's a historic inflection point that signals a fundamental shift in the global economy. The era of abundant, cheap industrial metals is over. For decades, silver was seen as gold's volatile younger sibling, a speculative play during crises but never a core asset. But today, silver is something far more powerful. It's the essential conductor of the clean energy revolution, woven into every solar panel, every electric vehicle, every data center, and every defense system. And unlike gold, which sits in vaults, silver gets consumed, embedded in products, and often lost forever. That's why this rally is different. It's not driven by fear or inflation alone. It's driven by real, irreversible physical scarcity meeting explosive structural demand. When a metal critical to decarbonization becomes harder to find than ever before, price is the only mechanism left to ration it. By the end of this video, you'll understand exactly why silver has broken out, why this surge is sustainable, how it affects your cost of living, your investments, and the pace of the energy transition, and why this moment may mark the beginning of silver's rise as the defining metal of the 21st century. To grasp the significance of $118.87, we must first understand what makes silver irreplaceable. Silver isn't just shiny, it's the most electrically and thermally conductive element on Earth. In solar panels, silver paste forms the microscopic grid lines that collect electrons from sunlight. Without it, efficiency drops by 20 to 30%. In electric vehicles, silver enables fast charging, power conversion, and battery management. A single EV uses 25 to 50 grams, and with 15 million EVs produced globally in 2025, that's nearly 20 million ounces annually. In AI data centers, silver cools high-performance chips and ensures signal integrity in 5G infrastructure. Even medical devices, from wound dressings to diagnostic sensors, rely on silver's antimicrobial properties. Crucially, there is no perfect substitute. Copper oxidizes, aluminum lacks conductivity, gold is too expensive. Engineers can reduce silver use, but they cannot eliminate it. This isn't optional consumption, it's engineered necessity. Now consider the supply side. Global mine production peaked at 880 million ounces in 2024 and is now in structural decline. Why? Water shortages in Peru and Mexico, the world's top two producers, are forcing mines to curtail operations. Aging infrastructure in Australia and Canada reduces output. New projects face decade-long permitting delays due to environmental reviews and community opposition. Recycling, once seen as a buffer, has plateaued at 180 million ounces annually because recovery rates from electronics remain below 20%. The result? A structural deficit of over 150 million ounces in 2025, covered only by drawing down exchange inventories. And those inventories are vanishing. COMEX registered stocks fell to 24 million ounces in early February 2026, the lowest since 2018, and equivalent to less than 3 months of industrial demand. London good delivery bar holdings outside China stand at a 12-year low. When physical metal disappears from vaults, paper markets lose their anchor. This is the hidden fuel behind the rally, real scarcity meeting explosive demand. But there's a third force, monetary accumulation. Central banks, led by China, Russia, and Turkey, have quietly added over 100 million ounces of silver to strategic reserves since 2022. Why? Because they see what Wall Street misses. Silver is both a hedge against dollar instability and a strategic industrial asset. Unlike gold, which is purely financial, silver offers dual utility in a fragmented world. Retail investors are also piling in. US, German, and Indian coin and bar sales hit record highs in Q4 2025, draining another 300 million ounces from available supply. This creates a feedback loop. Rising prices attract more buyers, which tightens physical availability, which pushes prices higher. It's not irrational exuberance, it's rational response to visible scarcity. Critically, this rally is not a repeat of 1980. The Hunt brothers' attempt to corner the market was driven by leverage, speculation, and a belief in monetary collapse. Today's surge is driven by cash buyers, manufacturers securing inputs, central banks building reserves, and retail investors taking physical delivery. CFTC data shows net long positions in COMEX futures are well below historical peaks, meaning this isn't a leveraged bubble. Instead, the action is happening off-exchange, in private deals between miners and industrial users, in sovereign vaults, and in retail bullion markets. This fragmentation makes the market less transparent, but more resilient to exchange-driven crashes. You can change COMEX rules, but you can't force a German solar plant to stop using silver. So why $118.87, and why now? Three catalysts converged in early 2026. 1. Solar boom accelerates. The U.S. Inflation Reduction Act and EU Green Deal triggered a wave of utility-scale solar projects. Each gigawatt requires 12 million ounces of silver. With 600 gigawatts under construction globally, demand surged overnight. 2. EV adoption hits inflection point. Tesla, BYD, and legacy automakers ramped up EV production, pushing silver intensity per vehicle higher as fast-charging networks expanded. 3. Physical delivery squeeze. In January 2026, JP Morgan and other major shorts on COMEX failed to source metal for contract settlement, forcing cash settlements at steep premiums. This exposed the gap between paper claims and physical reality. For ordinary people, the implications are direct. If you're planning to install solar panels, expect costs to rise. A $100 silver price adds $90 to $130 to a standard 400-watt panel, Wood Mackenzie. At $118.87, that jumps to $140 to $190, eroding grid parity in emerging markets. If you're buying an EV, automakers may pass on costs. Silver adds $130 to $180 to the bill of materials per vehicle at current prices. For investors, silver ETFs like SLV face a new risk. BlackRock's December 2025 prospectus warned it may encounter difficulty in acquiring sufficient physical silver. If the trust can't source metal, share prices could decouple from spot prices, exposing investors to counterparty risk. True ownership now means taking physical delivery, coins or bars stored outside the banking system. Moreover, this rally is reshaping geopolitics. Countries with silver reserves are recognizing their strategic value. Mexico is restricting exports of unrefined ore. Chile is prioritizing domestic refining. China, which refines 60% of global supply, is using silver as collateral in BRICS Plus trade settlements. The era of freely traded, fungible commodities is ending. In its place is a world of resource nationalism, where metals are weapons, not just inputs. Critically, the $118.87 price may not be the peak. It may be the new floor. Why? Because the clean energy transition is non-negotiable. Governments have mandated decarbonization. Corporations have committed to net zero. Consumers demand EVs and renewables. None of this can happen without silver. And unlike oil or copper, there is no strategic reserve to stabilize markets. The U.S. sold its entire strategic silver reserve in 2002. No major nation holds a meaningful stockpile. When demand outstrips supply, price is the only rationing mechanism. Some argue substitution will solve the problem. Copper plating in solar cells, silver-coated wires in EVs. These innovations reduce usage but don't eliminate it. First Solar's copper-plated cells still use 10% silver. Tesla's latest inverters cut silver by 30%, but not 100%. And these transitions take years and billions in CapEx. In the interim, the physical market remains tight. So what should you do? If you're an investor, allocate 5 to 10% of your portfolio to physical silver, not as a gamble, but as insurance against systemic scarcity. Avoid leveraged ETFs or futures. If you're a consumer, lock in prices for solar or EV purchases sooner rather than later. Delaying could cost hundreds or thousands. If you're a policymaker, restart strategic stockpiles, fund recycling R&D, secure domestic mining permits. This isn't about getting rich quick. It's about recognizing a fundamental truth. The green economy runs on atoms, not apps, and silver is one of its most critical atoms. The $118.87 milestone isn't noise. It's a signal from the real economy, a warning that the era of abundant, cheap industrial metals is over. Whether this leads to innovation or crisis depends on how we respond. But one thing is certain. Silver is no longer just a relic of the past. It's the silent conductor of our future. If you want clear, fact-based analysis of how resource scarcity shapes technology, finance, and your daily life, without hype, fear, or oversimplification, subscribe to US Silver Market. We track the real flows behind the headlines, because in an age of hidden shortages, understanding physical reality is your strongest asset.